And I bet you everyone is awake in this room at this moment. What a wonderful panel. I promised I delivered. Unfortunately, this particular panel is truncated as compared to some of the other ones, so we have a very short amount of time. We're actually about to run over, but I don't want to abruptly cut it off. I do want to say that we do not have time to go through all of the questions that I received, wonderful questions as they were. I'm just going to quickly pose this one question and ask everyone to just take maybe up to 2 minutes maximum to respond. And it's a very basic question, but I think a very important question, particularly for this audience. And the question is, what should we do? Based on your perspective, based on these comments that each of you have given today, what should each of the individuals and leaders in this room do when they leave this conference to make a difference? And I'll start with you, Jim.
Sure. So I regret I don't have an opportunity to weigh in on some of the other presentations, particularly Ad's presentations on the default characteristics of low down payment and low credit score loans. The irony I find in Ad's presentation is that Ad understands a lot of the problematic issues that were raised in terms of what FHA could be doing better to improve the underwriting of those loans as well as the servicing of them, including loss mitigation, which also gives you some perspective of why the loss ratios are as high as they are. And so I think there's some good parts of his presentation that I'd like to pull out, but I think the overall characteristic of low down payment loans, if they're fully underwritten, well underwritten, to individuals with low credit scores are inherently statistically significantly greater, is just false and it's not true. And there's a lot of data to point that out. The flip side of it is that, to go to Avis's specific question, I think the thing we need to do is start with basic principles. What is it that we want the housing finance system to do, and what does it have to do in order to achieve that? What does it have to do in order to make sure that borrowers who have low wealth and low measured credit scores are able to actually get a product that meets their specific financial characteristics? And everyone on this panel knows that it can be done, including Ad, because he's done some of the best work in analyzing how FHA's loan performance could be substantially improved. Then, moving from there, what is the way in which we need to bring private capital and government support to the table to make that market work? And as I said earlier, and don't work in a frenzy like we're working right now on Johnson-Crapo. Take the time to do it right. Explore those alternative models like cooperative, like utilities and other things, while simultaneously fixing the housing market's challenges right now, leveraging FHFA's authority and power, which it has, and it has a director who knows how to do it right. Let's focus a lot of attention there and help them get it right while we take the time to get the housing finance legislation straight. So, in fact, it is open to people of color, as Mitria has indicated it should be.
Okay. So one point, Mitria and Jim, the data that's on the slide about the risk, those are 30-year fixed rate, fully amortizing, fully documented, fully underwritten, owner-occupied, Freddie Mac loans that had normal interest rates. They had the whole 9 yards. And you see the default rates range from very low to extraordinarily high, and it's because of the well-known, it's been known for decades and decades and decades, and it hasn't changed. It's FICO's at point of origination, things like FICO score, loan term, purpose, LTV, debt-to-income ratio. That has not changed for as long as I've been in this business and before, and I've gone back and looked at the research. We looked at 1999, 2000 for a Freddie Mac, 2001, these same plain vanilla, not necessarily low-risk loans, and these relationships hold true. The ultimate default rates are lower, but still, the ones that had the low-risk characteristics had much lower default rates than the ones that had the high-risk characteristics. And so we've looked at millions, we looked at tens of millions of loans to look at this. And so you can, and I commend Bruce for what he does with $15 billion worth of trying to originate loans, but we have a mortgage market that's $10 trillion. And trying to ramp up from 15 billion to 10 trillion has been a challenge for this country, trying to do that, and it's been a failure for 60 years. So I've looked at this. This didn't start in 1998. I beg to differ. If you trace the history of failed policies, and Bruce, you're a little bit right on the VA piece, but the bigger piece was FHA. And FHA in the 30s, 40s, and 50s had down payments that averaged 20% or more. They had loan terms that were around 20 years or give or take. The VA had loan terms that were in that same region. They had debt ratios that were much lower than they are today. And the VA did have LTVs that were high. The FHA, as I said, had down payments that were 20% or more in general, average 20% or more for the first 25 years. That was an escalator. That word was used in an earlier panel. That was an escalator for building wealth, and it was successful. It was what I named the talk, a straight, broad highway to debt-free home ownership, because it allowed you to pay off the debt. And I think we agree, you have to ultimately pay off the debt. We've not had a policy in this country for 60 years of trying to pay off the debt that we put people into. So we take, what has been our policy for 60 years, is we take the people with the lowest income, who have the most income volatility, we put them into the highest leverage loans, however you want to define leverage. We make those loans in the most volatile neighborhoods in terms of house price, and then we say they're not building any wealth. Well, of course they're not going to build any wealth when you do it that way. That's been our policy since FHA really started doing those crazy loans in the 1960s and 70s, and then we got Fannie and Freddie doing them, and then we got the rest of the market doing them. That's a 60-year history. That's what needs to end.
I'm going to respond to that, but I think the better way to actually respond to that is, I was at the reception last night, and this person came up to me and she told me a really interesting story about building wealth. So I want to turn my time over to Natalie. Natalie, if you can stand and just if you can quickly tell everybody what you told me last night.
Natalie, would you mind coming up here, because we're videotaping and we'd love to preserve this for posterity. So while she's coming up, one thing I want to say, and I think it's an interesting talk on the technologies or the specifics on products and policies. I think we have to take it out of that, and we got to go back to the grassroots, and we have to engage in what NACA calls nonviolent bank terrorism. And what does that mean? That means that you hold these CEOs and the government personally responsible for their actions, and that means you go to their homes, you take over CFPB with over 1,000 people, you go to John Mack's house, head of Morgan Stanley, you take over Chase, you do that, and you've got to start taking them on in the streets to put the pressure on them and Congress and this government to do the right thing, because we can talk about the policy stuff. Let's get back to getting it done, and that's how we've always achieved things in this country that are important, and we have to go back to that, but it's important to hear from Natalie.
Good morning. Last night I saw Bruce, I recognized his face, and decided that I had to go over and tell him thank you. In 1998, I realized that I needed to buy a home, and I had no clue how to do it. Neither one of my parents had bought a home at that point. And a friend of mine told me about NACA, and I went through the program. I was blessed enough to have my house almost triple in value in about 5 years. And during that time, I recognized that I wanted to start a national nonprofit. I was able to, after buying my house through NACA, learning what the process was really about, no down payment, no closing costs, a low interest rate, a fixed mortgage that felt safe, I was able to take out a home equity loan in 2004 and start a national nonprofit. And in July, we'll be 10 years old. We have almost 50 staff. We have an office here in D.C. and an office in Jackson, Mississippi, and we work all over the country creating conditions for people to be healthy in their neighborhoods. And I had to go over and tell Bruce thank you last night because, first of all, I don't know that I would have bought a home or when that would have happened, but not only that, my mom has now bought a home. Not only that, I have at least 10 friends that I can list off the top of my head who have now bought homes. Not only that, amongst those 10, and I didn't tell you last night, there's one person in there that from buying his first home through NACA, he now owns 7 rental properties throughout Baltimore and DC. I call him the mogul. So all of that is to say, I'm appreciative of the process and what was made available to me through NACA, because not only did it allow me to buy my first home, it helped me to help my mom, other friends, and begin an organization that we hope is working to change lives and improve health around the country. So thank you.
And thank you for sharing.
I just have to add one more thing to that. When Ed's right, when, you know, $15 billion is nothing, is just a drop in the bucket. He's absolutely correct. But it's enough to show a standard out there that can become a national standard as a way to do it. And that's what we're about. Not just helping Natalie and a lot of other people, but set a national standard of the right way to do lending. Full doc underwriting, affordable mortgage payments that don't go up, fully amortizing, so over time you pay off that debt. There's no reason why that can't be done with trillions of dollars out there.
I will just say this. I have 2 thoughts for you. Number one is that if you want to close the racial wealth gap, you cannot ignore the housing policy debates that are going on in Washington, D.C. right now. And so the real point of, and the reason why I'm here today, is to ask people to actually start tuning in and talking about this debate. It is genuine. There are serious efforts to say that home ownership is a bad idea for certain segments of this country. The second thing I want to point out to you is to not be dissuaded by technocrats, I think, who often argue the numbers. The numbers are being manipulated. They are being manipulated to reflect a position that is more favorable to preserving preserving wealth at the very top of the rung and not allowing minorities to actually have a stake in moving up the economic ladder. And so we owe it to ourselves in this room to look at the facts. And when we look at the facts, we realize that the system that has been allowed to actually generate wealth for the majority of the nation and the majority of the community is now trying to close its doors when it realizes that people of color are the next wave of people to come through it. That's it.
All right. Thank you. Thank you once again to this amazing panel. And now, do you have some more remarks, Maya? Okay.
Again, let's give another round of applause for the panel. For those of you watching online, we will actually be taking a 40-minute break, so rejoin us at 1 o'clock. We will have Congresswoman Judy Chu, Congressman Tony Cardenas, Congressman Stephen Horsford, and later on, Congresswoman House Democratic Leader Nancy Pelosi. And so please, those of you who are in the room, go eat lunch and please come back. Thank you.